And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week. Of course, Friday's here, and supposedly we're getting cooler weather this weekend. It's going to be all the way down into the mid-80s. For Texas, that's cool weather. September's here. Starting to get dark a little bit earlier. Notice? Yeah. My bedtime's coming earlier. So my wife yesterday, over the years, we've collected all these gift cards, like for eating out and stuff, like in different restaurants and stuff. People will give us a gift card.
Yeah.
So we have a little box at home. We just throw them in because we don't eat out a whole lot, right? So we just throw them into this box. And so yesterday my wife was going through them. And she's like, we've got to start using some of these things. I mean, it's just, they're sitting here, they're going to expire, so I've got to use some. And so she scheduled dinner for us for next Tuesday. We're going to go have dinner together, go have a date night. Tuesday night, 5:30.
Beat the crowd.
Date night is now dinner at 5:30, bed by night. So,
there's something really nice about going into a restaurant around 4 o'clock or 5, and you're one of only 2 or 3 couples there.
Oh, I know. But this
you get
just
great service.
Right. So, it's just the realization that we're getting a lot older, right? And my wife always reminds me, we're not getting older, we're becoming vintage. So
I like that.
Yeah.
Yes.
So we're becoming vintage. And she's holding up. She's aging very well.
Yes.
So
yes,
she's doing very well. Anyway. So, a couple of things this morning, just before we get into it. So, Michael Lebowitz is going to join me this morning. We're going to talk a little bit about the Fed's latest call. One of the interesting things that we'll talk about this morning was Jerome Powell's comment this week that stocks are fairly highly valued. Are they fairly valued or highly valued or fairly highly valued? I mean, it depends on how you want to read that statement, but they are highly valued. Stock valuations are very elevated right now. Really, valuations across pretty much every asset class is overvalued because of this chase in the markets that we've had. Everybody's running up every asset class simultaneously, so we're all getting a big high correlation now between asset classes. Nothing wrong with that. That's what happens in a bull market. But it is reminiscent of Alan Greenspan's Irrational Exuberance statement back in 1996 when he was making a press conference and said, there's a irrational exuberance in the market. Of course, that was the beginning of the melt-up in the markets that started in 1998, 1999 in particular, and led to the dot-com crisis. So, again, it's kind of these statements that are made and kind of it's always interesting when you've been around the markets as long as Mike and I have. People will say things that we go, oh yeah, they said this before, and this is what actually happened. So just looking back at historical trends, that irrational exuberance moment, very much similar to Jerome Powell's statement this week, talking about stocks are fairly highly valued. Maybe they're not irrationally exuberant yet. We'll see. There's a lot of bets on AI and CapEx spending, of course. That's going to be the big driver for markets. We've talked about that before.
Did you just call Michael vintage?
Michael is vintage.
Okay.
Michael is so vintage, his label's coming off. So. Little dust on that bottle. That's all I'm saying.
There you go.
So. Anyway, all right, here's what you need to know before the bell this morning. Stocks, I don't know what's going on. My screen has been red 2 days in a row. Haven't seen that in forever. But yeah, the markets are pulling back here just a smidge, very slightly. Again, we've had 107 days now of the market's moving with less than a 2% move in one direction or the other. In other words, we're having a very low volatility move in the markets. 107 days isn't the longest stretch, but it's getting up towards a very long stretch. We've also had 5 straight months of gains, which if we finish out the month on a positive note, which looks like we will, we've also had 5 straight months of positive gains for the markets. That is a long stretch. 5, 6, 7 months are very long stretches of positive gains in the market. So again, doesn't mean markets are going to crash. I'm not saying that. It's just quit extrapolating what I'm saying. But I am saying that when you have 5 months of advances, typically you're going to have some give back here to some degree. So again, not surprising. Last couple of days having a little bit of a pullback here. trying to come down, touch this 20-day moving average. That's been running support. Right below that's the 50-day moving average. So again, that's also big running support here. Below that, you get a little bit more, concerning because you got the 100 and 200-day a good bit lower. But we are starting to work off some of that overbought condition. That was one of the things that we've kind of been talking about previously. Momentum is weakening in the markets. Breadth is kind of weakening. And again, remember, we talked about just a couple of days ago, we said, pay attention to what's going on because the markets are going up, but we're getting this decline in money flows, and eventually the market would catch up with that. So again, that's kind of what's happened here the last couple of days. We had that negative divergence between money flows and the rising markets, and now markets are trying to start to realize that, hey, there's not enough buyers out there. We've got more sellers showing up. So we're getting a little bit of a correction here. Again, nothing major to worry about here. Again, a little bit of a pullback here would not be surprising. But we're seeing stocks that, kind of getting a pullback here that have been the biggest winners. So we've had very big runs in stocks, particularly in some stocks, retail favorites, meme stocks. Those are getting hit harder than the overall markets. So again, just kind of something to pay attention to. Outside of that, one of the other kind of interesting things going on is, as we've talked before about oil prices, and oil prices have been kind of staggering along here, not doing a whole lot. But again, when you take a look at oil prices, like I said, they've been pretty flat, not really doing much at all. Now, this is the input, as we've talked about before, into energy stocks, right? So oil prices are where energy companies derive their profits from. So again, just at least worth paying attention to the fact that oil prices really aren't doing a whole lot. We are on a buy signal, and relative strength is trying to pick up. So maybe we're going to get a little bit of a move higher, but we're trading around $64 a barrel. That's pretty much been the case for the last couple of months. However, take a look at what's going on with energy stocks, because energy stocks are starting to get a bit of a breakout here. And let me get a little different chart here. This is kind of what's going on. We've got a nice little breakout in XLE. So this is the energy ETF. Even though oil prices have been trading flat, which are, again, that's the input that feeds into the profitability of oil companies, and there's historically a very high correlation between XLE and oil prices. Starting to get a little bit of a break of that. Energy prices have been rallying nicely. We've got a golden cross going on right now. The 50-day starting to cross above the 200-day moving average. So that's all very bullish. We're starting to get a turn up in relative strength, but a little bit of a move higher in oil and energy stocks. We're going to get a bit of a breakout of this consolidation that we've been in here for a while. So again, energy stocks yesterday actually had a very good day. While the market was selling off, we've talked about this rotation that occurs in the markets. You kind of go from offense to defense. Well, energy stocks have been on that more defensive side of the ledger, right? Lower volatility. They pay decent dividends pay well dividends in a lot of cases. But they've kind of been the laggers to the market. So we're starting to see a little bit of that rotation from the high risk beta momentum trade back into some of those more defensive names. We saw that yesterday. But again, just kind of keep an eye on energy stocks here, because this divergence between energy stocks and oil prices is interesting. But there is a bit of a bullish story developing behind energy stocks as well. So kind of keep an eye on that. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Vintage. Michael Lebowitz, talk about the Fed and the markets and a whole lot more. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So,
Vintage,
yes. Michael Lebowitz joining me this morning. So Mike wrote an article this week, it's posted on the website yesterday. It's talking about accommodative or restrictive and talking about kind of the Fed's latest move. But Mike, before we get to that, it was interesting that Jerome Powell made the comment, as I mentioned earlier, that markets were fairly highly valued. So I thought the wording choice was interesting. Not highly valued or not, maybe overvalued, but just fairly highly valued. So I just thought the word choice was interesting.
Yeah, what is he throws? I think he threw the word fairly in there so that someone couldn't say he pulled another Greenspan.
Right.
Saying the market's just grossly overbought.
Right.
That would have been much more exciting if he would have said that.
But it's interesting because again, him kind of recognizing where markets are valuation wise, and here you've got the Fed starting to cut rates again. But you really kind of take a look at inflation. You've got, inflation's coming down. It is heading towards their target, but we've kind of gotten to that era now where the year-over-year rate of change is kind of working against, dramatically dropping inflation, but inflation is going to eventually trend lower. But it's still kind of sticky where it is right now. And there's certainly some impacts in the economy from things that are going on that, like with tariffs that are feeding into higher prices in some areas of the markets. But you got that. Then you've also got, this market that's just kind of on fire. So you have these fairly highly valued stocks that are doing well, but yet now you're kind of, theoretically adding fuel to the fire by cutting rates. And because investors have been wanting rate cuts to improve the discount rate for forward earnings to justify overpaying for fairly highly valued stocks, right?
You think investors are trying to justify that something with a P of 400 now becomes more acceptable because interest rates got cut 25 basis points?
Yeah, exactly. So your discount rate goes down. So now your PE is only, $3.98. That's a bargain.
Yeah, for Pepsi and McDonald's and Walmart and those kind of companies, But, these companies are trading and look, they're not even trading on earnings. They're trading on expected earnings. So I think what matters to a lot of the speculative companies are earnings growth. Mm-hmm. Where are earnings going to grow? And it's not clear that even that's tied to the economy for some of these companies, that it's tied to AI. And can the AI engine keep fueling this subset of companies? So I think Powell, the Fed, Bernanke made it very clear, right, that the direction of the stock market has an impact on the economy, the virtuous circle, as he liked to call it. And that's about as close as a Fed chairman has come to telling you that there's a linkage between the economy and the stock market, and that they think about that. Mm-hmm. So even though their two mandates are employment and inflation, my guess is Powell is worried about the stock market, not just that it could drop decently, crash, whatever, but that it's fueling excessive spending, which is keeping inflation higher than it otherwise would be. Right. And look, if the S&P fell 30% this week, I guarantee you inflation would come down quicker than it would if it didn't fall 30%, right?
Right. Oh yeah, no, exactly right. And again, there's a clear linkage between, the Fed and the stock market in terms of, we go back to Ben Bernanke 2010, and he's, about to engage in the second round of quantitative easing. And he says, look, the whole reason we're doing quantitative easing is to, increase asset prices to boost consumer confidence, which will help boost generate economic growth. And so that was when they kind of revealed that third mandate, of the market relative to their agenda of stabilizing economic growth. But again, when you've got the market already doing exceptionally well, it's, you're starting to, provide more incentive to increase those asset valuations even more and potentially run the risk of creating the very thing you're trying to avoid, which is a collapse in the market.
Right. So I just wonder if that's one of the things that's keeping Powell from cutting rates too quickly. And many of the other Fed members, they're scared that they're going to either further fuel the speculation that's going on in all markets. Look, it's not just it's not these highly speculative stocks. It's crypto. It's corporate bond spreads are at record lows. It's all gold. silver. It's all over the place.
And again, there's nothing wrong with that. I don't want anybody to leave the conversation today going, oh my gosh, Michael Lance are saying the markets are about to crash. We're not saying that. We're just saying that there's a lot of speculative activity and it's spread across markets. And and that's the thing that, again, we've kind of mentioned this a couple of times over the last week or so. The concern for investors is not that the markets are going up. Just because markets are going up, that doesn't mean that the markets are going to crash, right? It's just that's not the thing to be concerned about. What is the thing to be concerned about to a degree, and not necessarily today or tomorrow, but eventually the problem is that when you have all asset classes that are typically non-correlated to each other, in other words, you have some asset classes that don't perform as well as other asset classes during a risk-on environment, but when every asset class is all going up on a risk-on environment, the problem with that is that when you get the correction, whenever it comes, it goes across all the asset classes. There's basically no safe place to hide. And that's the concern that investors need to be concerned with, is looking at your portfolio and saying, okay, I've got exposure to all these different asset classes that have now all become much more correlated. And in those type of environments, what happens if there's a risk-off event? And again, not saying that there will be. This market could continue to go up for months, maybe even longer, right? Before some event comes along that causes a risk-off change. But when you look at your portfolio and say, okay, this is where I'm allocated, what happens if there's a risk-off event? Where's the money going to go to? Because money doesn't leave the market. It just rotates somewhere else. And so when it begins to leave high-risk assets or assets that are extremely extended, it's going to go to other places. And so the trick is trying to figure out where that money rotation is going to go to.
Right. And that's where we spend you talked about it with energy stocks. That's where we spend a bulk of our efforts trying to figure out where the money is rotating to on a daily basis, but where's it likely to rotate to if the market really does change its trend? Mm-hmm. So, it bears really following that stuff today so that when you really want to see those big, broader macro trends, you're on top of it and ready to go.
Yep. Absolutely. Well, so let's talk a little bit about this chart that you put in your article, which is basically a quadrant. And I thought it was interesting. So, when you kind of think about things in terms of, actions that are being taken versus potential outcomes, and this was directly relating to the Fed and what they're doing, is the Fed, is the Fed creating risk in the markets, or are they acting aggressively to quail markets, et cetera? So you can kind of put this into a quadrant, and then Brent, you can bring this chart up. But this is the quadrant that's in the newsletter, in Mike's article, which is talking about in the upper right quadrant, kind of where we are now, is that you've got the Fed too loose, economy doesn't really need it. And then, of course, where they kind of move to from here, are they too tight or too loose? Well, from your view right now, at least, and you can explain this, is you think the Fed's acting too loose, or the Fed's become too loose here with monetary policy, even though the economy doesn't really need it right now.
No, so the graph the quadrant you're talking about is something I saw on social media.
Oh, okay.
And that's someone's guess at where we were. And he thinks we're way too easy. He just threw a red dot up there, right? There's no calculations. He just decided the red dot goes there. And I was like, that's fine, and you can think that, but let's just actually do the math and see where we are. So when you scroll down a little bit more into that article, you have a very confusing quadrant graph. Same concept.
Which I will let you talk about as we show that graph right now. Go ahead.
Okay. Is it up there now?
Yes, sir.
Okay. So what you see are the four quadrants, and basically the economy is above trend. Is the economy above or below trend, and is policy restrictive or accommodative? And you can see the green box in the upper left and a red box in the bottom right. The upper left is where that first graph basically says we're too easy. The economy is running above trend and policy is easy. That was 2021. Remember when the economy was growing 2, 3, 4% above the trend rate of growth and Fed funds were still pinned at zero? That's about as Goldilocks as it gets for the stock market. We're actually restrictive. You could see that red dot in the bottom right. It's kind of near the mid horizontal line. And basically, Fed funds are 1.6, 1.7% above the inflation rate, and the economy is below trend, slightly below trend, but below trend. Now, what this doesn't include is QT. The Fed is still doing QT, which on its own is restrictive. So if we added QT to this mix and QE, those 2021 dots would move up further to the top left corner, and the current dot would move a little bit further to the right. So, I think Fed policy is restrictive. I don't think that they're necessarily goosing the economy by lowering rates. I think they're, when they cut rates, it's obviously less restrictive, but I think it's still restrictive. And, Powell must have used that word 5 times during the press conference, that policy is less restrictive, but still restrictive. Stephen Moran just gave a great speech, which we'll talk about that next week, about how policy is too restrictive. And he lays out, he quantifies why that's the case. And again, Lance, just one point. How many times have we talked about shelter prices grossly lagging reality? If you just consider that 0.5% of inflation is due to faulty CPI inflation reporting, Fed, the inflation rate is much closer to its 2% target. So that makes rates even more restrictive at 4 to 4.25, that much higher than the inflation rate, especially with growth well below trend. Not well below, but below its trend rate. And estimates aren't that great for the rest of the year for economic growth. So, it's very easy to throw a dot on a piece of paper and say it's Goldilocks and the Fed's making a huge mistake, and they're going to goose the economy and goose inflation and goose the stock market. But when you do the math, that's not the case.
Well, no, and this is this is kind of the big conundrum that we have right now. Again, when there's plenty of arguments to be made. Again, when you kind of look at some of the underlying leading economic indicators, certainly suggest that maybe the Fed's behind the curve in terms of cutting rates, that the economy is actually a lot weaker. And then you look at other data, and it certainly doesn't suggest it. So, again, it's, your analysis is correct about where we are. Again, I guess the question becomes is how does the market adapt to that, right?
Market doesn't care. But what we do know is, a little bit further in that paper, we actually, every one of those dots, which is a quarter since, I want to say we went back to like 1955, and it shows you how we did for the next 3 months. And there's clearly the worst return to be in is in the bottom right. The best is in the top left.
Yeah, well, let me put that chart up for everybody real quick here. But go ahead and keep talking.
But I wouldn't, I think that's generally true, but you have to be very careful because, as you saw in my first graph, you don't have to be precisely in the middle to have perfect policy. There's a range of policy that's appropriate. So, in theory, you'd want to strip out all the periods where we had appropriate policy and leave them out of the analysis. But I think what you're going to find is when the Fed is too restrictive, given the economic growth rate, given inflation, the market doesn't do as well as when as like periods like 21. Think about it. When the economy is roaring and the Fed is is basically setting the interest rate at 0, that's the best case scenario for stocks. Where we are now is not a good scenario. And Lance, we talk about this. Of the S&P 500, 400 and whatever, 450, 60, whatever the number is seeing no earnings growth.
Right.
So it's not goosing earnings, right? It's not goosing the economy. The economy is below trend, and it doesn't appear to be rising significantly above trend anytime in the next few quarters, at least. So again, you have to be careful when people just tell you, the Fed's just way too easy and stocks are going to go to the moon because of that, because that's not the fact.
Well, and
stocks have gone to the moon despite restrictive policy.
Exactly. And the other thing about it too is that, again, the market's always searching for a narrative. And I think it's interesting to see is like, before we were talking about earnings and AI, and now we're shifting that narrative towards CapEx spending, and now we're shifting the narrative more to profit margins. And we're starting to see profit margin compression to some degree, but again, expectations are like, oh, well, AI is going to, and the productivity gains from AI are going to allow, company margins, corporate margins to stay elevated. That's going to be good for stock prices. But again, as you start to look out into next year, the expectation by the market is that the economic growth slowdown we're having right now, this is the soft landing that everybody's been talking about, and we're about to re-accelerate economic growth next year, which will feed into earnings. And so earnings estimates have been getting ratcheted up. We're now expecting about 17% gain in earnings for next year, which is fine, but it's well above, the deviation right now from earnings, from the long-term growth trend of earnings, which aligns with actual economic growth, is the highest deviation on record. So, the expectations my point is that, when you look at your data and you compare that to the expectations of the market, the expectations of the markets are far ahead of what's actually happening on the ground with real economic activity.
Right. And when you kind of look at this AI story, and let's look at a company like Walmart. Mm-hmm. They must have thousands of buyers, right? For all the different types of products that they probably more than thousands, right? That seems like a job AI could probably do pretty well. Mm-hmm. They know how their inventory is moving. They know what's hot at other stores, what's hot on the market, what's new. AI could probably figure that job out. And I apologize right now to anyone that's a buyer, but AI could probably do a good job at doing that. So if you're Walmart, you adapt AI. That's great. You've created some efficiencies. Mm-hmm. You can probably lay off a few thousand people. And that's nice. You're going to cut expenses. And by default, you're going to grow earnings by a little bit because you have less expenses. But those few thousand people now are unemployed and they're not buying Walmart products. Mm-hmm. So there's a pro and a con, a give and a take to the whole AI thing. And, just like with the tariffs, everyone said tariffs are going to create massive inflation. That's not the case. And part of the reason is because it's also creating hardships for consumers, and they can't spend as much on other goods. So, everyone likes to look at the nice shiny side of this brand new AI mm-hmm. car that we have, but the other side has some real flaws to it. So, so it's again a question of it's not just that AI is here, but when do those profit boosts start showing up? Is it next quarter or is it, and I'm talking about for regular companies. I'm not talking about for Google or NVIDIA, for the 5 or 10 companies that are directly benefiting today. It's when does it hit the mainstream? And that could be a while.
Yeah. It's funny you brought this up because I just posted this chart this morning on our X account and talking about this kind of the very same thing is that the markets are doing very, very well and heading into rate cuts. And Brent, if you can bring this you can bring up the whole quote as well that goes with it. But basically, this was a quote from Goldman Sachs. So what this chart shows is where the market is currently and how the market typically responds post-Fed rate cuts, either if the economy is in recession or not in recession. So if we're not in a recession, stocks tend to do very well because you're not in a recession, so the economy is growing. Makes sense. If you're in a recession, then you have an earnings decline, and that becomes problematic. But the comment by Goldman Sachs, Mike, I thought was interesting. So let me read the quote, which is headline index levels shouting that all is good, yet beneath the surface, sticky inflation, and we're starting to see the end of the pass-through working and falling volumes. Margin compression and job cuts are appearing. All of this at a time, and this is to your point, Mike, all of this at a time when AI is supposed to be offsetting some of those impacts with potential and efficiency, which ironically, if true, also probably adds to more job cuts. The first Fed cutting into a cyclical uptick in an equity market at all-time highs and an economy still close to full employment relative to history. Their point is that there's probably some risk to that outlook, and there's also some risk to this idea that AI is going to cure all the problems for the market. To your point, because it increases unemployment, which drags on economic growth because those people no longer have any money to spend.
Right. It's a double-edged sword.
Yep.
And I think over time it works itself out, but that time is not the next few quarters as the market seems to be pricing in. It could be years before, and again, we're talking about Main Street corporations. We're not talking about the 5 or 10 that are just making trillions on top of trillions here, mm-hmm. which are driving which are solely driving the S&P earnings and really the performance of the S&P 500.
Right. And again, to your point, Walmart has already talked about they are implementing AI into their business, obviously. And they are, have already talked about how this is going to impact, for instance, like people that actually price all the products. AI can do that very efficiently. That will cause hundreds of job losses just in that one sector of their business. So when you start thinking about, the impact of AI on jobs, you have to really think about what your job is. And we've talked about this before. And I have this conversation a lot with my kids now. Is like, you've got to pick a job that is not a repetitive task of some sort, because any task that is a repetitive task, such as, calculating numbers or pricing products or whatever it is, AI can replace that very quickly. A repetitive task, particularly if it's inputting something into a computer or calculating some type of outcome, AI can do that very efficiently. And so this is going to be one of the problems, is that as companies focus more and more on that bottom line, the biggest cost for every business is employment, right? It's not just the people you're paying, but it's also the benefits and everything else that goes along with it. There's a lot of cost there. And so if I can start eliminating some of that high ticket cost for my business, I can grossly improve my bottom line margins, which is the bet by the market, by the way, but that's not necessarily great for the economy.
Right. And one of the things that's kind of hallmarked the last few years for companies, they've been scared to lay off people because it's been really hard to rehire people. It's expensive to lay them off. It's expensive to rehire people. Might that trend be changing right now? And if so, there could be a lot of layoffs in the works if companies are more comfortable laying off and not holding extra employees. And look, at the end of the day, it's all about margins, right? Executives get paid based on the stock price. The stock price goes up in part because of earnings. Earnings are a function of margins versus its sales. So as margins compress because of tariffs, because of other things, because of a weaker economy, that's where the CEOs, who again are getting paid off stock, have to do something. And they may cut marketing, they'll cut employees, they'll cut overhead, they'll shut down potentially factories. There are various ways that all kind of hurt the economy that they can bring those margins back up, but to the detriment of the economy and in part to the detriment of sales to that company.
Exactly. So, I guess the question to kind of wind this conversation up with this morning, and then we'll talk about a couple other things, is, the kind of the risk for investors going forward. Right now, complacency is very high for investors. There seems to be no concern about, chasing stocks. They only go up. Although this morning it looks like we're about to start our third down day in a row. So we'll see what happens. But, again, the stocks that have been leading the run higher are now under a good bit of pressure here. So we're starting to see a little bit of that kind of fade as we head into the month. And that's not really surprising, by the way. Just because the market's pulling back here a bit is not surprising, because we are heading into end of quarter rebalancing. So a lot of people are starting to rebalance portfolios and that type of stuff, trying to get ahead of the end of the quarter. And a lot of these stocks that have had really big runs, they're just getting pared back down to size. So you're getting a bit of a pullback in these asset prices. Again, not the end of the world, but Mike, when we take a look at volatility in the markets, again, as I was noting earlier, we've got 107 days with a very muted market. Markets are up 30 basis points a day, down 30 basis points yesterday, but very muted moves here. Not a lot of concern or stress in the markets. Again, as you mentioned earlier, credit spreads are extremely tight. Credit spreads right now, just posted another chart of this morning on X. If you take a look at global credit spreads, which is kind of interesting from a couple of different levels, but investment grade credit spreads, and Brent, you can read this chart up for me. This is investment grade credit spreads going back to 2010. But credit spreads right now are the tightest that they've been since 1998, which I thought was interesting from the standpoint that, low credit spread suggests that there's no systemic risk in the markets at the moment, which is leading to a lot of this complacency. But it's also a warning, because typically when you have extremely compressed volatility and very, very tight credit spreads, it typically precedes an unwinding of that complacency at some point.
Lance, I'm actually looking in SimpleVisor. We have credit spreads as well.
Right.
And I'm looking at the 20-year history for everything from AAA down to BB is in the top 1% of its credit spreads. And in many of those cases, that the top credit spread was in the last 2 weeks. So other than C, which is still in the top 10% of its credit spreads, everything is at historical tights, like you were saying. Mm-hmm. The other thing I think that's very interesting, like it's very easy to be scared off by this, but the other thing that's very interesting is like when we look at valuations. Mm-hmm. In 1929, the CAPE ratio, which uses 10 years of earnings, is more stable. It's a nice long-term valuation, a way to compare markets. It hit 32, right? Mm-hmm. And what followed was an awful market crash, a Great Depression. In 1997, it hit 32. And there were certainly people saying, this is it. We're at the same level. The last time we were at these levels, we had 10 years of a depression. Mm-hmm. The end is near.
Right.
They're walking around with the end is near signs. But, the market then went on for another 2 years or so, got up to a CAPE of 44, much higher.
Right.
Right now we're at 40. So there's still 10, if earnings go nowhere, there's still 10% in the market just to get up to where we were at the peak of 99. But that doesn't necessarily even mean that that's the peak. Maybe we go to 50.
Right.
The point is, you could say the markets are rational, and in the long term, it's very irrational right now, but it can get a lot more irrational. And the one thing I like to think about is if you look at those tops in 29 and 99, mm-hmm. they're not just, the opposite of a V-shaped top where it goes up and it goes straight down. They trend higher, they bounce around. There's a battle between the bulls and the bears. The bears start winning. You get lower highs. Your technical signals start triggering. And there's a bunch of indicators. So we're not talking about a plane that's going to just fall out of the sky from 40,000 feet. That really doesn't happen.
Right.
What happens is the plane starts bouncing around and you get a sense that there's something wrong.
Right.
So
an engine falls off.
Yeah, something like that. Look, and I'm not saying we are we pay a lot of attention to fundamentals. It's very concerning. It creates a lot of tension, but it's a fact that what's expensive can get a lot more expensive. Right. And it makes it very difficult, but it's something we have to do.
Yeah, and it was interesting you said that because yesterday I was doing an interview with Charles Payne on Fox Business, and he asked me the same thing. He's like, hey, you wrote this article. So Monday's article on the website is analyzing the bullish and bearish case for the markets. And so he read that article, and he's like, hey, this is a great piece, but are you recommending people get out of the markets now? And the answer is no. And the reason is that valuations are, and Mike's right, talking about valuations where we are right now. We're at 40 times on the CAPE, which is like, again, 44 was the peak in the dot-com crisis. So immediately everybody can go, oh my gosh, that means the markets are about to crash. No, what valuations represent in the short term, right now, this month, this week, this quarter, this year, it's just sentiment, right? It's as investors are willing to pay higher prices, you're going to get higher valuations. What valuations do tell us over the long term is that forward returns will be lower for a lot of reasons, because simply prices are so far ahead of the earnings that expectations are going to get disappointed at some point. But Mike's absolutely correct. And this is why we pay attention. I brought up this chart of credit spreads. So on SimpleVisor, if you're interested in credit spreads, you can go to simplevisor.com and you go to the DIY research, and there's a tab for credit spreads. And basically it has a variety of credit spreads from AAA to C junk bonds. And you can look at the different credit spreads. But again, what those tell you is that when credit spreads are very low, that's when you have, or very tight, I should say, that's when you have a lot of complacency in the markets and people are willing to overpay for stocks. There's no systemic risk apparent in the markets right now. There's nothing that's worrying the credit markets at the moment because people are willing to extend credit and take a lower rate for it. In other words, investors in the bond market aren't really getting paid for the risk they're taking, particularly in some of the areas of the markets. But when, and this is a good indicator, when you start to see credit spreads begin to rise and that tightness begin to go away, that typically is a good leading indicator for stress in the markets. It may not show up in stock prices yet, but it'll start to show up in the bond market, the credit market itself. You'll see it in interest rates. You'll see it in other areas of the markets, and you'll start to see these early signs like Mike's talking about where you get a bit of turbulence, the lights are flashing in the cabin and tells you that something's potentially going wrong long before the plane actually starts a deceleration due to gravity. And that's kind of the same thing with the markets. And you go back and look at the 2007 crisis, go back to the dot-com crisis. We talk about the dot-com crisis like one morning we just woke up and the market was down 50%. No, it took months for that market to top and then began to roll over, even as we had Enron going on. And then WorldCom became an issue, and then it was Lucent, and then it was Global Crossing, and these things were just mounting up, and it was taking some time. But eventually the market started grinding lower because of this reality that expectations were far ahead of reality.
And even I wrote an article about 1987 a few years ago.
Yep.
Even 1987, which I think a lot of market historians deem to be the plane that just fell out of the sky, that wasn't the case. There was about 3 weeks of trading that there was clearly some trouble in the market, and it was sending signals that the bullish trend that preceded it was in trouble. Now, that was a huge decline, and it came back really quickly. So it wasn't like 1999, like 1929, like 2007. That would take a long time to recover its losses. Very different event, but still, it gave signals. So the point is, we're not going to pinpoint the top. I can guarantee you that. But you will see a definite change in market tone, in what stocks are leading the market, in technical indicators, in a whole host of things. And it may not be the top. It may just be stuttering for a little bit and then go higher. At which point you can, if you had sold and reduced exposure, add back exposure. The party's back on. That's great. The cops drove right by the party. They're going to someone else's party, right? But at some point the cops will come to the party, and you're going to hear the sirens well before they bust through the doors. Right. So keep an eye on the exit door.
Yeah.
But don't leave it yet.
Well, again, that's the hard part, right? It's as and this is the challenge that we face managing money every day is, there's an inherent part of both you and I that are extremely conservative and tend to lean towards more of the bearish side of the argument because a lot of fundamentals back that up. But at the same time, we have to fight that with the momentum of the markets and realizing that right now, that momentum trend in the market remains very strong. It hasn't broken yet, but we may see that eventually break. And when that breaks, then we're going to raise more cash. We'll take some action. But this is the challenging part of the market, is not to become overly complacent, because then you stop paying attention to these risks. And then by the time that something occurs and you realize that something has happened, it typically tends to be too late and you've already lost a good chunk of money.
And, I would add, we may be coming off as nonchalant about valuations. Lance and I talk about this way too much. We have a portfolio management meeting every morning where inevitably it comes up 3 or 4 times a week, where we'll talk about it or some of our colleagues will bring it up. We're very mindful of what's going on. We're very mindful that the risks are much higher today than they were if, say, PEs were 7. And we're not nonchalant, but we understand market history and what can happen from here. And we have a great set of tools to help us really understand what's going on in the market, what stocks are leading the market. Is the tone changing? Is momentum changing? So,
yep. So Mike, as we get ready to wrap up the show, I have a pop quiz for you. This was in the Wall Street Journal this morning. So let's test your knowledge of Fed jargon this morning, just to see how good you are. Okay?
Go ahead.
All right. So question 1, what was once called milking the street is better known today as what? A pump and dump operation, a Ponzi scheme, a boiler room scam, or insider trading?
I'm going to go pump and dump.
All right, we'll see how good you are here in a second. So you're correct. I'm going to give you that one. Buying a stake in a salted diamond field would be a good investment. True or false?
Say that again. Buying
a stake in a salted diamond field would be a good investment. True or false?
False.
Yeah, you're correct. Salted means that the diamonds in this case have been spread around the location to fool investors' belief that it's actually rich in deposits. When a company makes a large extra distribution of money to stock to its shareholders, the act is colloquially referred to as sharing the wealth, revving the engine, cutting the melon, or harvesting the corn.
Sharing the wealth?
No, cutting the melon, which is a phrase that goes back to the early 20th century. All right, so one more here. Wildcat money was once a disparaging term related to which industry? Timber, oil, land speculation, or banking?
Oil.
Banking. Wildcat money. You're failing your test this morning. You're 50. I'm going to give you one more question because you're at 50% right now.
Okay, make or break.
Wildcat money referred to the currency printed by unstable banks in the years before the National Currency Act of 1863, which moved the U.S. towards a national currency and banking system. One explanation of the term is that many of these banks were intentionally located in obscure places, which was called wildcat money. Okay. Your ancestor was a cambist. What was his specialty? Precious metals?
What?
Cambist.
Was a what?
Cambist. C-A-M-B-I-S-T. You're going to fail this question because you don't know what the word is.
Exactly.
What was his specialty? Precious metals, hog futures, railroad logistics, or foreign currency exchange rates?
I have no idea. Foreign currency exchange rates.
Ding, ding, ding. You got it correct. So you're at 60% right now. Cambist is an archaic.
I go on to the next grade level.
Yeah, cambist is an archaic term for a foreign exchange expert. So there you go. There you go. Good job, Mike. Here, I'm going to give you one more bonus question to wrap it up. What was traded on a curb exchange? Municipal bonds for infrastructure projects, Class A shares capped, stakes in businesses that were traded on the street, or the curb, or small cap mutual funds?
I think it's Class A stocks.
It's stakes and you were doing so well. Stakes in businesses that were traded on the street or on the curb. That was what was called curb exchange. It started in the 1830s, and people would stand on the street corner and trade stocks.
Under the whatever elm tree or oak tree on Wall Street.
Under the
right?
elm tree, that's correct. So yeah, we'll give you 50% on that one. Anyway, all right, that wraps up our show for the day. Mike, thank you so much for joining me this morning. I'll be back tomorrow, of course, with Financial Fitness Friday. Be sure to go by the website, realinvestmentadvice.com. That is realinvestmentadvice.com. Get Mike's latest blog post talking about the Fed, too accommodative, too restrictive. He goes through all the analysis for you. All the charts are there. It's on the website now, along with our daily market commentary. Be sure and like and subscribe to the channel. It certainly helps us out as well. We certainly appreciate you very much. Be back here tomorrow. Have a great day.